The visual paradox of the 21st century isn't a starving population, but a global superpower suddenly losing its appetite. We are witnessing the first biological disruption of the consumer discretionary sector, where a single molecule, semaglutide, is effectively decoupling the human reward system from the industrial food complex. For decades, the $1.5 trillion global food industry relied on a predictable bliss point, a precise ratio of salt, sugar, and fat designed to bypass executive function and trigger compulsive consumption. But as GLP-1 agonists like Ozempic and Wegovy achieve mass market penetration, that neurochemical bridge is being dismantled. This isn't just a medical trend. It's a structural deflationary pressure on calorie-dense economies. When Walmart's internal data begins flagging a measurable dip in total basket units, specifically among patients on injectable satiety hormones, we aren't just looking at a pharmaceutical breakthrough. We are looking at the controlled demolition of the hyper-palatable food era, a shift that threatens to strand billions in retail infrastructure designed for a hunger that no longer exists. The economic fallout of suppressed craving is creating a caloric void that the stock market is only beginning to price in. We have entered an era where the most valuable commodity isn't the food itself, but the biological off switch that renders marketing spend obsolete. Consider the strategic vulnerability of big food. Their entire valuation is predicated on volume growth and share of stomach. If the average GLP-1 user reduces their caloric intake by 20% to 30%, concentrated almost exclusively in ultra-processed snacks and high-margin carbonated beverages, the fundamental math of the grocery aisle collapses. This isn't a gradual shift toward wellness or a fleeting New Year's resolution. It is a pharmaceutical intervention that alters the demand curve at a cellular level. As we track the flow of capital from Nestlé and PepsiCo toward Novo Nordisk and Eli Lilly, we realize that the Ozempic Effect is the ultimate asymmetric trade, a scenario where a $1,000 a month shot can bankrupt a business model built on the $2 impulse buy. To understand the magnitude of this disruption, we must analyze the dopamine industrial complex that has governed the S&P 500 since the 1970s. Following the Nixon-era subsidization of high-fructose corn syrup, the food industry evolved from a provider of sustenance into an engineering powerhouse focused on sensory-specific satiety and vanishing caloric density. This era saw the rise of semantic nodes like craveability and mouthfeel, where food scientists optimized products to trigger the nucleus accumbens, the brain's primary reward center. The result was a feedback loop of overconsumption that fueled the growth of multi-billion-dollar giants. These companies didn't just sell snacks, they sold a solution to a biologically engineered itch. However, this model relied on a static human biology, one that remained susceptible to the siren call of processed carbohydrates. The industry assumed that while consumer tastes might shift toward organic or natural, the fundamental biological drive to consume would remain constant and exploitable. The arrival of GLP-1 medications has introduced a biological black swan into this environment. Originally synthesized to manage type 2 diabetes by mimicking the glucagon-like peptide-1 hormone, these drugs were discovered to cross the blood-brain barrier and silence food noise, the intrusive, constant thoughts about eating that drive impulse purchases. By slowing gastric emptying and signaling the hypothalamus that the body is in a state of permanent nutritional surplus, semaglutide effectively renders the $500 billion global advertising budget for fast food invisible to the consumer's brain. This creates a massive misalignment in capital allocation. For 50 years, the most efficient way to generate alpha in the consumer sector was to increase the frequency of purchase. Now, for the first time in history, we are seeing the emergence of a biological firewall that prevents the consumer from responding to external stimuli. The strategic context here is a pivot from an era of induced demand to an era of chemically enforced restraint, a shift that turns the industry's greatest strength, its addictive nature, into its greatest liability. The architectural impact of GLP-1s on the balance sheets of big food is nothing short of catastrophic when viewed through the lens of incremental margins. In a typical grocery retail model, the middle of the store, the aisles filled with crackers, cereals, and confections, accounts for nearly 70% of the operating profit, despite occupying less than half the floor space. According to recent Morgan Stanley longitudinal studies, GLP-1 patients reduce their consumption of confections and salty snacks by up to 50%. This creates a unit economic death spiral. As volumes drop, the high fixed costs of manufacturing and shelf space logistics remain, crushing the EBIT margins of companies like Mondelez and Kellogg's. Furthermore, the elasticity of craving has been broken. Traditional price promotions, buy one, get one free, lose their efficacy when the consumer's satiety threshold is artificially lowered. We are seeing a 1.5% to 2.5% drag on total U.S. caloric demand, a figure that sounds small but represents the entire growth margin for the mature food sector. Furthermore, the indirect cost profile of the Ozempic effect extends into the healthcare and insurance sectors, creating a value migration away from traditional consumer staples. If GLP-1 adoption reaches the projected 7% of the U.S. population by 2030, the total addressable market, TAM, for weight loss-related comorbidities, sleep apnea, knee replacements, and cardiovascular management could shrink by $200 billion. This creates a secondary hit to the food industry, the health economic feedback loop. As governments and private insurers realize that subsidizing a $1,000 monthly injection is cheaper than treating the chronic results of a $10 daily fast food habit, the regulatory pressure on hyper-palatable foods will intensify. We are already seeing the emergence of satiety scoring in investment portfolios, where analysts discount companies with high caloric exposure. The dark scheme here isn't a conspiracy, but a cold mathematical reality. The food industry's externalities, the health costs they previously offloaded onto society, are finally being internalized through pharmaceutical competition. The most granular threat lies in the behavioral data divergence. For decades, loyalty programs and credit card data allowed companies like Kroger or McDonald's to map consumer habits with terrifying precision. Now, that data is becoming noisy. A consumer who was a heavy user, the industry term for the top 20% of customers who drive 80% of revenue, can become a minimalist overnight after their first subcutaneous injection. This disrupts the customer lifetime value, CLV calculations that underpin the valuations of nearly every QSR, quick service restaurant chain. If the heavy user cohort, which consumes an average of 3,500 calories a day, drops to a maintenance level of 1,800 calories, the revenue per user doesn't just halve. The profitability vanishes because the infrastructure was scaled for the 3,500 calorie world. We are looking at a potential stranded asset crisis in the form of thousands of drive-thrus and production lines that are no longer optimized for the modern, medicated human biology. In response to this existential threat, the titans of industry are attempting a pivot to protein and a radical rebranding of nutritional density. We are seeing the great reformulation, where companies like Nestlé are launching specialized brands such as Vital Pursuit, specifically designed to accompany GLP-1 treatments. The goal is to capture the residual spend of the medicated consumer by focusing on micronutrient fortification and muscle mass preservation. This represents a fundamental shift in business logic, moving from selling calories per dollar to selling utility per ounce. Companies are desperately trying to transform from suppliers of indulgence to partners in weight management, hoping to replace lost volume with higher-margin functional foods. This is a high-stakes gamble on category migration, the hope that a consumer will pay $5 for a high-protein, vitamin-rich small portion rather than $3 for a giant bag of empty carbohydrates. However, the strategic shift goes beyond mere product development. It involves a total overhaul of the marketing funnel. The old AIDA, attention, interest, desire, action model is failing because the desire phase is being chemically suppressed. Consequently, brands are moving toward educational sovereignty, attempting to position themselves as experts in the GLP-1 lifestyle. We are seeing a surge in asymmetric brand positioning, where food companies partner with telehealth platforms to bundle healthy snacks with drug prescriptions. This is a desperate attempt to maintain share of mind in a world where share of stomach is shrinking. The winners in this new landscape will be those who can decouple their revenue from caloric volume and reattach it to bio-optimization. The losers will be the commodity calorie providers who are too slow to realize that the era of the unlimited appetite has reached its biological and economic limit. The Ozempic Effect serves as a profound lesson in the fragility of any business model that relies on exploiting human biological vulnerabilities. For half a century, the food industry enjoyed an asymmetric return on equity by capitalizing on an evolutionary mismatch. Our bodies were designed for scarcity, but the industry provided a surplus of addictive triggers. This arbitrage of the limbic system worked perfectly until technology caught up. The capital lesson here is that innovation disruption doesn't always come from within your own sector. It can come from a completely unrelated field, like molecular biology, that fundamentally alters the user interface of your customer. As investors, the imperative is to look for resilient demand, sectors where the value proposition isn't based on a bypass of human willpower. The companies that will thrive in the 2030s are those that recognize we are moving from an economy of excess to an economy of precision. The hunger game has changed. The goal is no longer to fill the stomach, but to fuel the cell. In this new paradigm, biological alignment is the only sustainable competitive advantage.